Do they get tax advantage status though? Because technically, wouldn't it be an unrelated business activity and be taxable to the nonprofit? Well, for example, if I run a nonprofit like a charity, and then I choose to buy mineral land that's producing royalties, I have to pay tax on that, even though I'm a tax exempt entity.
Kind of sounds like OpenAI.
That's exactly
right?
what. Yeah, no, that's exactly what it is. Except OpenAI's.
So how does that work out in reality, right? Like if you're, maybe we don't know the answer to this, but a nonprofit entity, right, pulls in cash, doesn't pay any taxes, pays their expenses, but you got to spend everything.
Correct.
Right? You can't retain any profits.
Well, you can actually retain profits. You just have to make sure a certain amount of the retained profits go toward a particular cause. So, for example, like a private foundation has a 5% distribution obligation at the end of the year, where 5% needs to go to a charitable cause, and the rest can actually stay in the coffers.
Yeah. Okay. But they can't take those profits and then use them for more profit, right? They can't invest in projects and that sort of thing.
They actually can.
Okay.
But those particular projects that generate revenue and profit potentially trigger a taxable event as an unrelated business activity.
So would that DQ the nonprofit from being a nonprofit?
It doesn't disqualify it from being a nonprofit because it could still have nonprofit actions. It just has taxable enterprises within a non-taxable umbrella.
Okay.
So those separate subsidiaries may be taxable even though the larger organization is not.
Okay.
Yeah.
Okay.
It gets really confusing.
Welcome back to the Ask Avidian podcast. This is Jake Borbidge, Chief Investment Officer with Avidian Wealth Solutions, and joining me today is Robert Palmer, our Head of Financial Planning. You might wonder why we're talking about nonprofits and profits and mixing those two things together, and why does that even matter? There was an interesting article that came out, I think it was a couple days ago, about the University of Utah. Are they the Utes? Is that the University of Utah? Let's get a fact check on that. But the University of Utah is now the first university, and actually it's a public university. So it's kind of owned by the state. First public university to take private equity dollars as investment. And so without knowing the situation too closely, it sounds like they carved off a piece of their sports program and sold it to a private equity firm. We're not going to name firms' names. I don't think we're supposed to talk about brand names in this podcast. But a private equity firm got them a check for $500 million. They get a big chunk of the a non-controlling, but a large non-controlling interest in the kind of the revenue or the profits of the sports side of the business, which, as everybody knows, college sports is highly profitable. Those tickets are not cheap. They're still cheap where I went to school. Lehigh University, if you guys are looking for a good value, Lehigh football, great value. However, and it's still college football, still D1, but cheap tickets. So the cash flows now, I guess, are partially contributing now, or partially owned by this private equity fund, right? So, we're trying to figure out, like, okay, number one, is it's got to be allowed, right? I'm assuming that they kind of did their homework. Lawyers did their homework. I'm sure the university had, was lawyered up. The private equity firms probably lawyered up. I'm sure they figured out that this is, somewhat above board, or at least doable. But it kind of, tells you a couple things. One is that the views on sports investing are continue to get more and more positive. Capital is flowing into that industry, and because there's not a lot of places to put it, it's actually capital's finding new places to get placed. Kind of hard to buy a portion of a NFL franchise.
Good luck with that.
Yeah. Well, I mean, it's tough, right? Number one, you can't own a controlling stake, right? They still have to be owned by the families. But also, they don't come up for sale often. Nope. You can only buy small chunks. The valuations are incredibly high.
Insane.
I don't know what the valuation of this purchase was, but my assumption is that the valuation of the investment in University of Utah is probably a little bit lighter than if you want to buy a fraction of the Dallas Cowboys. 1.5. Peanut Gallery says 1.5 billion. So it sounds like they got about a third ownership, which is a big chunk. Probably not going to take on any more majority investors. Maybe they got a couple smaller investors in there. That's a pretty good sized chunk. You're not going to get that size of a chunk of an NFL franchise.
No.
But I guess what I was thinking of is, like, at that $1.5 billion valuation, what is the revenue of that sports complex? Like, how does that compare from a multiples perspective, right?
Yeah.
And my guess would be that there's probably a discount from college to NFL would be my assumption.
Oh, for sure. But still highly profitable, I'm sure.
Yeah.
The amount of money that schools typically put toward these programs is significant, and the amount that it generates for the school is extremely high.
Yeah.
So Jake, if I'm an investor and I say, well, I'm not a big private equity firm, but man, I'd
Get
really
me
like
some
to.
Utes.
Yeah,
Get
I
me
want to
some
own
Utes.
some sports teams.
Yeah.
How do I go about collecting these cards?
That's a great question. Great question, Robert. It's something that we've actually been doing a lot of research, and some of our private equity sponsors are, a little bit ahead of the game. They've actually formed, funds that are dedicated to sports investing, and so sports investing is starting to become kind of a material asset class where people are starting to consider, okay, it's usually still within private equity, right? Some of it's going to bleed over into venture capital depending on what you're investing in. So sports investing can be anywhere from like a minority ownership or majority ownership, depending on the league that you're investing in, of recognized franchises. So NFL is obviously the one that comes to mind. That's probably the hardest one to access, the most expensive. A number of NBA franchises have taken private dollars already. The Formula One franchises have taken private dollars. Soccer or non-American football has taken some private dollars. Like most sports franchises, we were looking at a deal not too long ago. I want to say it's not pickleball, which also has private equity. It was a franchisor of triathlons, actually. And so they were looking at forming capital to facilitate triathlons around the world, which apparently is a capital-intensive business, but also a very sticky business. And so if you wanted to put dollars to work in the sports investing world today, most of those dollars are going to have to be invested through private funds or private companies. Likely, it makes sense to have a partner there to help kind of go through the due diligence process, understand the asset class. There's a number of things that are to like about an asset class like sports investing, but there's obviously different risks than you take on with just kind of investing in an industrial company, real estate company, and a lot of people are still kind of learning.
Well, I want to talk a little bit more about the logistics, because I think conceptually a lot of people have the idea that private equity comes in, they buy a chunk of the company appreciates in value, then they sell the company and distribute profits. I think that's a general...
That sounds like a great recipe.
It does sound like
Let's
a great recipe.
That. Rinse and repeat.
I'm just wondering if in this sort of public institution sector where you have this pro-business arm in the form of entertainment with professional sports, how liquid is that? How tradable is that? Like, what is there a huge market for it? Is that what you're saying?
As liquid as the next person coming up that wants to make a purchase, right? So from that perspective, that liquidity is definitely not guaranteed. So as with any private investment, right, there's never a guarantee of liquidity. Even with liquidity enhanced vehicles, there's typically not a guarantee. Unlike in the public markets, if I own a publicly traded stock and I want to sell it, there's kind of almost contractually required liquidity by the clearinghouse, by the brokers, that they're going to, even if the market's tanking, they're going to step in and provide liquidity. They have to, and they have to take risks to do that. Yeah. That does not necessarily exist in anything in the private market space. So sports investing is no different. I think, given that it's an asset class that is, kind of on the horizon of just becoming a little bit more mainstream, that asset class has continued to see inflows, right? Okay. So in an asset class that's in net inflows, usually liquidity is a little bit less of a concern because most people are making their first investments. They're not thinking about the exit plan. However, when an asset class reaches maturity, and maturity could be thought of a number of different ways. One way to think about maturity is that the footprint is no longer expanding in client portfolios. It's more reached kind of a stable level and is maybe just churning's not the right word, but it's turning out profits. There's rebalancing going on. The attractiveness of the asset class may change. So maybe there's some overweights, some underweights. That's kind of more of a mature asset class versus where sports investing is zero in most people's portfolios and going to, a more positive number. So in that situation, most people aren't thinking about liquidity. It's probably less of an issue now because there's inflows. And so if you were to take a position and buy a minority stake in a professional sports franchise, a lot of those franchises are still seeing upward revisions to their valuations. Finding a buyer, 3-4 years from now may be less challenging than, if this was a mainstream asset class and the incremental buyer is no longer there.
Well, I think also that, as you pointed out, this is a new asset class for a lot of people. And if I'm looking at it, I don't really have an understanding of the type of cash flow I can expect or the type of appreciation that I can look at year over year. Do you have any insights into that?
Well, I think the hardest thing with a new asset class is that, like, I mean, the thing that's not new about sports is people have been going to professional sports games for decades and decades, right?
Well, I'd say thousands of years, going back to ancient Rome.
Yeah, thousands of years. And I wonder how much a ticket used to be, like how many shekels.
At the Coliseum?
At the Coliseum. How many talents of gold did you have to pay to get in a Coliseum? And was it like more of a first come, first serve, or is there assigned seating, closer to Caesar?
I'm pretty sure it was just to keep the masses at bay while they starved, for the most part.
Yeah, just like a distraction.
Just a distraction.
You get too hungry, they throw you to the Tigers.
Something like that.
Okay. Well, anyway,
Anyways.
Thousands of years, right? Sports investing has been around.
Thousands of years.
Yes, entertainment's been around for a long time. But there is a lot of data on revenues, because franchises often they have tax benefits, right? So they do have to file some public financials. So there is data in terms of like the growth of revenue of privately owned sports franchises. However, what there's very little data on is if you own a minority stake in a business like that, what does it look like as an investor? Obviously, there's fees, there's transaction costs that come into play when you make that investment. So there is very little data as it relates to an investor or a limited partner's ownership stake and how that might profit, an owner. So we can study how the asset class may have performed. We can study, areas that might be newer and heating up, areas that might be more mature and cooling off. But it is very hard to study, what would an investor's experience have been. There's no mutual fund that we can look at. There's no sports investing index that would have gone through the great financial crisis. And so watching an investor's experience through a volatile time period is something that's really hard to observe. And so when you talk about sports, typically you look at, the asset class and not necessarily the investor, potential investor experience, and you try to think about things like, okay, in a financial downturn, is it an asset class that's resilient, or is it an asset class that is cyclical and has volatility and does better off of a recovery, right? And so, the proponents of sports investing would lead you to believe that it is a fairly resilient economic activity, that when people are, face hard times, they are more likely to cut travel expenses than, say, going to their favorite, franchise's sporting event or playoffs. Playoffs, right? Nobody said playoffs, right? And so it has shown to be economically resilient. But I think if you look at, kind of towards the future, some of the things that sports investing has shown, some potential opportunity is if you look at just media in general, right? Streaming has made traditional media somewhat of a challenged way to think through, okay, well, what is really monetizable? How do I draw audiences in?
Yeah.
So, for example, the most popular show that you could think of, right, the must-see TV, streaming has allowed people to consume that at their leisure, right? Which makes advertising to those audiences very challenging, because they're going to consume it whenever. A lot of times you want a product advertised at a certain point in time. And so if you're an advertiser, you're not really certain when that advertisement might be consumed, or if you get to advertise at all. A lot of streaming services are ad-free now.
Yep.
Sports is different, right? Sports, if you don't consume, especially if it's a big event, if you don't consume that sport live while it's going on, you obviously face the risk of showing up next day at the water cooler and somebody spoiling the the score, or even on your way home, you're going to get, if you happen to have a meeting, you wanted to watch the game, halfway through and catch up, you get alerts on your phone. It's hard to kind of insulate yourself from that. So sports definitely still has that, kind of must see while it's live type of feature, which advertisers definitely like. And so it has the potential to draw audiences.
Well, it definitely has the eyes looking at it during those time periods. But speaking of eyes, I wanted to pivot to the optics, because we're talking about a public institution
Good
bringing
play
in.
On words.
Thank you very much. Really trying over here. You have a public institution that can take taxpayer dollars, and it's deductible as a donation of sorts. And now some of those funds are going to help support the enterprises of a private equity investment. So from an optics standpoint, this might not pass the sniff test, even if it's legally permissible. Now, I haven't looked under the hood as to how this is structured, but my guess is that this is sort of treated almost like an unrelated business activity similar to how a charity would function, where if they had a for-profit business within a charitable umbrella, it would still wind up being taxable.
Yeah.
But it's curious to me as to how do you balance an investor's objective to return a profit and the school's mission to improve resources and functionality for its students, and where do those funds get directed in terms of priority? How do you balance that? Does that inherently cause a conflict?
Well, you're saying that because they're making money off of sports, they're more likely to invest more money in sports to drive that profit?
I'm actually thinking more of like the school generates revenue through only a few channels, and athletics is easily one of its highest revenue channels, if not the highest.
Yep.
And some of those funds come back to the school and help to improve the school. But if now you have a private equity investor that you have an obligation to help generate a profit for, does that pose a conflict for those revenue streams to go back and benefit the school more?
Yeah, most certainly, because there's more people, or I guess more people with their finger in the pie that have, different motives, right? Obviously, private equity firm, we invest in private equity. We understand the motives are for profit. That's why we place capital at risk with private equity firms. So there are definitely some differing views. Now, I would expect that the sales pitch on the private equity side is if you take our capital, the pie grows. So more fingers will fit into that pie. To be determined. Obviously, this is the first capital flowing into a university of this, in this style. Then nobody knows what the real answer is. But that would be my guess as part of the sales pitch is this is going to help you grow the relevance of the program, which is going to help you in a number of different ways, add dollars, presence, national presence, right? Ability to get good recruits, which all those things, you would hope snowball into a stronger, more relevant program over time. Better ticket sales, bigger, bigger stadiums. It attracts more people to the university, right? And so a number of different, follow-on benefits. Not sure if that actually happens, but I can see where your aspirations may be as the university. It's great that we're talking about college football because on the pro side, my Eagles have just been struggling. And so we're insulated here, thankfully. We've got the Texans to watch. The Texans have been on a absolute tear. Love watching them, and I love the ability that I can kind of pivot to the Texans. But man, my Eagles have been really, really struggling. We got a lot of Aggies here. We got a lot of UT guys, a lot of Longhorns as well. But Aggies have been doing really well, but kind of hit a little bit of a roadblock with the Longhorns a couple weeks ago. So college football playoffs coming up. Exciting stuff's going to happen this weekend. It's kind of the first kickoff, I believe. So looking forward to that. But let's get into kind of, real stuff that actually matters to our clients. We're coming up on the end of the year. A lot of things going on. It's been a few weeks since we did our last podcast. And aside from, college sports, which have probably been most of, the nation's focus, especially coming off of Thanksgiving and playoff brackets getting set, markets have been moving around a little bit.
Oh, yeah.
Right? Market's been moving around a little bit. Depending on what you own, you might feel like a genius or you might feel like a little bit of a goat in a bad way, not the goat. So, we've seen a few things change up here in the last couple weeks or a couple months of the year.
We got a rate cut.
We got a rate cut. All right, let's start with the positive stuff. Right? We got a rate cut. Now, what did the market think about that rate cut, right? It came in, it was yesterday, right?
Yeah.
So rate cut comes through yesterday. What happens?
Well, I think it's interesting to put it into context because most of the rate cuts, as we went into the announcement, were pretty much baked in, and there was a very high, meaning above 90% certainty that they were going to happen. And people were making a big deal prior to this most recent one that there was only an 80-some-odd% chance of a rate cut rather than a 90-some-odd% chance. Yeah. And so you saw the VIX actually.
That pulled off of like a probabilities website, or is that what's in like a Bloomberg screen?
I'm always curious how they come up with these percentages. I know they use the dot plot that they monitor the Fed with. They take the votes from the assembly, and they're just like, there's an 80. But you know what? I still think it comes down to gut instinct and guessing. Okay. No, at the end of the day, the VIX jumped up a little bit, so there was some volatility going into the rate cut announcement. There was the potential that they weren't going to do it because the government shutdown kept critical data away from the public for a certain period of time, so it became harder to predict. And then the rate cut was announced, and everybody was happy and relieved, and the market went up. And then in the afternoon, though, it started pulling back a little bit. And this morning we saw the Dow up and the SPY and the NASDAQ down, right?
Yeah.
The S&P and the NASDAQ down. So I think that there's some mixed results here. I think they're worried about additional rate cuts, which may or may not have been partially priced in coming in January, whether or not that's going to happen. And a lot of employment data. I mean, I hate to be doom and gloom, but there's clearly some...
Doom and gloom. All right, Freud, where are we at?
But there's clearly some cracks here in the economy, particularly with the labor reports, unemployment, even though there's some mixed results there. Defaults are up. Margin loan interest is at an all-time high.
Yeah.
I mean, there's a lot of scary stuff.
A lot of information coming at you, right? And so, like,
tons.
It's easy to try to point to one thing and then extrapolate all effects drive back to this one point, right?
Yeah.
But in reality, there's a lot of things going on at one point in time. A lot of information that investors are trying to digest simultaneously. So we'll talk about two pieces that were moving in opposite directions yesterday. One was obviously the Fed rate cut.
Yep.
Markets generally view that positively, although sometimes when it's baked into too high of a degree, then the sell the news kind of effect is what you would see. But I'd say low 90s, maybe that's not absolute certainty. High 90s, absolute certainty. So maybe that's where you see more of that sell your news reaction. So the markets, I think, would say initially positive reaction. However, you're also getting, like, Oracle reported earnings overnight, and the stock was down double digits, right?
Yeah,
and Oracle's already been struggling over the last couple of months. And so you're kind of getting these two, and I'm not going to say the market is completely reacting to Oracle as well, but you're getting information sources that are telling you a couple different things at the same time. Financial conditions, at least as it relates to the Fed funds rate, are easing. Still not a lot of liquidity out there. The Fed just got done wrapping up QT on,
I believe, December 3rd.
December 3rd. Okay, so that is an ending of a draw of market liquidity, which is generally not necessarily a good thing. It's not a reversal and an injection of market liquidity, which tends to be a good thing, right?
Yes.
So that's happening, but you have easier rates, but then you also have some significant, we'll call it earnings volatility. So Oracle's interesting. They have taken on a little bit of a different approach to building out their chips. Publicly traded company, but has taken on a ton of debt. So it's very visible that they are dialing up the risk of their business model to get out in front or to catch up in their ability to create processing power, compute, build AI tools for their clients. And so there's that bet is not going to be without risk. You dial up the risk of your portfolio through leverage, obviously, or the risk of your company through leverage. The markets tend to not view that as a positive thing, and that's coming home to roost where the markets are starting to get a little impatient with Oracle. They want to see results, and they want to see them apparently before today.
Yes.
Right. And so you're seeing both of those things, and I guess today what we're seeing market reaction is that the less AI exposed names tend to be doing well, right? And you would say, well, those names are probably more influenced by interest rates. Down the market cap spectrum, they're going to be companies that tend to be a little bit more highly levered and more levered towards short-term borrowing, so mid-cap and small-cap, cheap companies versus expensive companies. And so they did see a little bit more of a firming in their prices versus the AI names, which are a little bit softer today. Some of them are down significantly. Some of them are down just marginally in sentiment. There was another tie-up with OpenAI today too, as well. Another company had announced a partnership with OpenAI. I forget the name of it, but so a number of those tie-ups still continuing to go on.
Well, that could also be a healthy sign, because I think what a lot of people were worried about is that all this frothiness in AI was going to eventually cause a bubble burst and the whole market was going to collapse.
Yeah.
I personally take a little bit of comfort in seeing just the AI stocks start coming back toward the ground, while other companies with solid revenues and fundamentals are continuing to grow a little bit. That makes me feel like maybe there's a little more stability and not everything's going to collapse like we keep reverting back to 2008 every time we hear about a bubble burst.
Yeah, I mean, it kind of tells you that maybe the market does have the ability to work through and separate information to assign it to categories that you don't have to react unanimously on one piece of information across your entire portfolio. Kind of interesting that you mentioned the kind of that binary market mindset, which I think one of the things that we track. We have a number of things that we track. One is a risk aversion parameter, right? And basically what it tells us is, or what it tries to measure is how risk-seeking the market is, or how risk-averse the market is, right? And the way I think about that is, risk-seeking behavior means that you require less of a return to take on a unit of risk. And like I think about it, like I tend to be somebody that doesn't like heights, right? And so if there's a light bulb out in my house, and I know the cost of the light bulb and I know the cost to change the light bulb, it's basically zero. So if a lamp loses a light bulb, I'm just going to change the light bulb. If I lose a light bulb that's, kind of over the dining room table, I could probably reach up and replace it for free. But if I've got a ceiling with an arch, or a raised ceiling where I might have to get up on a ladder, that light bulb is the same cost, but now I have to get up to an elevation that I might not be comfortable with. And I might feel a little apprehension in doing so. Now,
that happens to me more than you because I'm 5'5" and you're 6'5" or whatever you are.
Well, and so that's where I think about like risk aversion to me is, okay, it's going to cost me the same amount to change that light bulb that's 25 feet in the air in terms of dollars, right? So the return is the light's going to be on and I'm going to be short one, unit of light bulb. However, the risk is, if I make a mistake changing that light bulb, number one, I could fall to my death or to my injury, probably less likely to be, dead from a 25-foot fall. But potential injury is definitely in my mind every rung up that ladder that I go. Now, if, I just felt really brave, maybe there was something that took my inhibitions away and I decided to change that light bulb, that would be my risk aversion decreasing, and I got up to that top rung and maybe I'm doing a little bit of a dance because I feel good about it and I'm not, not concerned at all about the fall, right? But the return, changing that light bulb, has not changed. And so that's how I think about, our risk aversion parameter. It doesn't change necessarily the expectation of returns. It just changes, how much risk you're willing to take to capture that return.
So maybe the AI stocks have been the 25 volted ceiling light bulb that you're trying to replace.
Yeah, where you just go up there. I'm trudging up that ladder, no worries at all. I just jump, I grab that light bulb, I do a little spin in the air, come back down, right? That was 2 months ago. Now I am holding that like white knuckle grip on that ladder. I'm still getting up there and changing that light bulb, but I'm always keeping 3 points of contact, right? That's where the risk aversion parameter has reset a little bit.
3 points of contact. Yeah. I like that.
And I might even go to the fuse box and turn off the fuse if you guys are listening for advice if changing a light bulb.
That's holistic planning right there.
Yeah, that is the full Avidian family hug. So we are coming up to the end of the year, right? Couple things that I think make sense to touch on. Robert, I know you've been giving us some end of the year reminders. We don't have a lot of time left, but for some of our listeners, they might just be waiting to hear our recommendations on things to just kind of clean up your financial life as we get closer to December 31st.
Absolutely. Well, first off, here are a few key reminders. One, you got estimated tax payments coming in January. Make sure that as you're rebalancing your portfolio, maybe harvesting some losses, that you're freeing enough liquidity to make sure your tax bill is covered in January if you're covering those estimated payments. Second, I would say for those who are charitably inclined and that itemize their taxes, this is a great year to take a larger charitable deduction because going into next year under the One Big Beautiful Bill Act, which I'll just call OBA moving forward, your charitable deduction is going to be reduced ever so slightly. So this year, you're able to write off 37 cents to the dollar at the highest marginal tax bracket, and the whole amount that you donate is going to be part of that deduction calculation. But going into next year, the first 0.5% of your AGI will not be deductible out of that deduction. And the maximum you'll be able to write off per dollar if you're in the highest bracket is 35 cents to the dollar instead of 37. So if you had a high income earning year this year, maybe make a larger charitable donation.
Is that kind of like bunching, right? You try to take some deductions more in 2025 than 2026?
It is bunching. Sometimes bunching is associated with carrying forward the deduction to the next year as well. What I would say is that focus on maximizing what you can take this year, because if you roll anything over till next year, the 0.5% AGI floor will still hit you.
Yeah. Okay.
So it's really just about maximizing this year. And I would also say, so we got tax loss harvesting, we got estimated tax payments, we got charitable donations. If you're a business owner, make sure you're capitalizing on those new permanent provisions that OBA set up. Qualified business income. You want to make sure that you're deducting that correctly and calculating that correctly. You take those SALT deductions, which is a $40,000 write-off starting next year. You want to make sure you're doing that. And I'd say the last thing is the other permanent provision is Section 179. If you're looking to reduce your distributions that your company is going to make to you and purchase a capital asset, maybe improve the equity value of your company, do it before year end. That way you can reduce the distribution. It'll be non-taxable. Instead, you're reinvesting in the business with a capital asset. Those are some pretty good planning tips.
Hey, another fun fact on cryptocurrency, right? So cryptocurrency has been coming up a lot, not in a good way. Cryptocurrency is definitely, I think, pretty much across the board, other than stablecoin, down, multiple double-digit percentages from the top. However, year-end tax planning tips, right? Cryptocurrency, we heard the words tax loss harvesting, right? Mm-hmm. So just to be clear, Avidian's not telling you buy cryptocurrency or sell cryptocurrency, but there are some opportunities making lemons out of that, or making lemonade out of those lemons that you can come into through the end of the year, right? So, so what about wash sales in cryptocurrencies? You know anything about that? Some rules changing, so I might have stumped the teacher here.
Yeah, to be honest with you, we're still waiting, ironically, on clarity. I say ironic because there is a Clarity Act going through Congress right now with regards to how crypto assets are treated and regulated. I actually don't know if you purchased it, if you'd be able to write it off, or how you'd be able to write it off.
So it's a trick question here.
Yeah.
Right, there is no wash sale rule with regards to cryptocurrency.
Okay.
Yeah, so you can... Again, this is not official tax advice. This is just me communicating things that I've read about cryptocurrency. We don't advocate for ownership of cryptocurrency, but we know a lot of our clients own it on their own, or they've decided to make purchases. Most of them have made purchases and have seen decline in value. There's probably a lot of harvestable losses there, but not having the wash sale rule means if you owned Bitcoin and you saw a dip of 25% and you sold Bitcoin, you could buy that Bitcoin back the same day. You don't have to buy a like kind. You just buy the exact same thing back the same day. So that has, I think, been the rule for a while.
It has.
You don't have to wait that 30 days. The nuance to that rule now is I think you have look through on wrapped vehicles that buy Bitcoin, or other ETF providers of ETFs that buy cryptocurrencies. That wash sale provision used to not apply because it was basically an equity or an exchange traded product. So you're not necessarily buying and selling cryptocurrency. Now it does. So now those ETFs also you don't have to worry about that wash sale rule. So you can sell your crypto ETF, buy it back same day, next day, within that 30-day window, and you're still good. You still get that harvestable loss.
So just for clarity, does that apply to the investor buying the ETF, or the ETF fund itself can avoid the wash sale?
I believe it's the investor, but it might be both.
That's interesting. I would have thought that the ETF, because it's traded like a security.
The ETF is going to be more like an ETF that owns any security is going to be more like kind of exchange in and out anyway. So they don't have to worry about that as much.
Yeah.
They typically exchange in and exchange out at exchange out the highest cost basis, exchange in at the lower cost basis. So you have some differences there that work with public and private stocks. So that in kind is different, but the wash sale rule not applying means that you don't have to sell your Bitcoin and buy Ethereum, which you may or may not like. You can go Bitcoin to Bitcoin and still harvest. You basically are bottom ticking, or trying to bottom tick your cost, harvest a little bit of loss, but you're not really out of market for any extended period of time.
Yeah, that seems like that should be addressed in short order, I'd assume, within the
You think that's a loophole? You don't think that should happen?
I do think that's a little bit of a loophole. I think it kind of goes in line where if you own SPY and it's at a loss, you can sell it and then buy VOO.
Well, I think that's one that, as a practitioner here, I think we try to avoid that because it's too close, right?
Yeah, it's close.
But I think because of the underlying is just currency, I think that's why it doesn't apply to cryptocurrencies.
I mean, it's curious. I'd be interested to know how they treat it moving forward. I know that there's two major acts coming out, one of which being the Clarity Act over the next probably few months.
Yep.
I know one's passed the House, one's going through the Senate, so that should provide us with some regulatory insights on how to treat all this.
Okay. Wanted to get to the year-end stuff before we get to our last topic, just in case we're boring people. Last thing's going to be on private credit. Because again, we've been going a couple weeks between these things. Private credit has been in the news quite a bit over the last handful of weeks and months. A number of financial transactions have started to soften. There's actually been some fraud. Some things have gone south as well in the private credit space. We've seen some loans written down substantially, and we've seen the asset class as a whole start to soften. Which is something that we do keep quite a close look on. We have a number of clients that have invested into private credit. We have been I would say, favorable on that asset class. The level of returns has been fairly attractive that we've received. The risk level, the private credit asset class has shown very low volatility over the last couple of years. However, going forward, we are starting to see, I guess I would call this a more normal private credit experience. So when you invest in private credit, typically you're investing in smaller companies, not publicly traded companies a lot of times. Most of the time, those companies are not rated by a rating agency. So you kind of call them unrated. Some people will call them, below investment grade. So you are, playing in a different pool. These are not treasuries. These are not investment grade bonds that you're investing into. However, the experience of the last couple of years may have lulled a lot of the owners of private credit to sleep because it's been such an easy experience with very low defaults, very low workouts, and actually even depressed levels of PIK, which is payment in kind. We can get into that in some detail if we need to.
Pick that apart.
Yeah. That's a good one.
Thanks.
So what we've seen is recently, aside from the newsworthy failures of some of the credits that have gone out, and credits, some of the failures have been due to outright fraud. Very difficult to catch even with robust due diligence processes. We have not had a material negative experience in our private credit assets, but it has hit a number of the kind of leading market brand private credit portfolios, not in a hugely material way, but there definitely have been some exposures. But then there's also been some softening of just kind of the overall business climate and the borrowers, where you're seeing an increase in PIK, which means that there's less current interest being paid in cash, and that interest is allowed to accrue kind of towards the back end of the loan.
Oh.
Now,
is that like a liquidity crunch sort of situation?
Yeah, and crunch maybe not the right word. So typically, if you loan to a growth-oriented company, you know that they're not highly profitable day one. You're betting as the lender on the growth of that firm, and so typically, many of those loans will have a PIK provision where if there's a need for a reduction in cash servicing of that debt, the interest doesn't go away, it just gets added to the back of the loan. And the idea is that the near-term cash needs are going to be more growth focused.
Got it.
That's an understood feature of many of these loans going in. And when you see an increased utilization of that PIK feature, it doesn't always mean that there's negative outlook on the company. Sometimes it means there's positive outlook and they want to invest more heavily with more capital projects, which consume more current cash, but also improve the growth profile of the portfolio. So that is one thing that gets thrown around a lot. It's not it on its own is not just a red flag for the industry, but it is something that we watch because you have to understand the reasons. Now, the other thing that we've seen tick up, I would say more slowly, is non-interest accruing or non-accruing credits, and that I would say is a more concerning piece of your portfolio. So if you start seeing your portfolio increase the number of loans, or see an increase in the number of loans that are not interest accruing, that's a lender's way of saying we have a reasonable expectation that that loan is not going to repay its debts.
Oh.
And so those are kind of two different ways of looking at, kind of if you're getting quarterly reports, if you're reading about these portfolios, one, could be an issue. One more certainly is an issue, and kind of delineating between those two is pretty important.
And do you see these cracks or these flags that are starting to be raised, yellow or red, whatever they may be? Do you see them as pockets here and there, or is this something that you're seeing broadly, maybe in small doses across the entire sector? No,
so what we've seen, and we don't have perfect foresight into all loans, be perfectly transparent.
Of course.
We have seen the cracks or the struggles more in cyclical businesses versus non-cyclical businesses, which kind of makes sense. We're getting this is a long drawn out bull market, but cyclical businesses, if they're seeing some softness, if they got hit by inflation, if lower end consumer behaviors are the bulk of their purchases, which we've seen some of that too. That was one of the loans that went bad. That's where we've seen the most struggles. And that's not unsurprising, because cyclical industries will have, good times and bad times, whereas more kind of stable non-cyclicals should be more steady Eddie and less dependent on the economic environment.
Mm-hmm.
And so I would definitely stop short of saying that there's like a market-wide weakening in the private credit space. However, I think it's also, worth just kind of mentioning, like, a lot of the, challenges and the bumps of the road should just be kind of part of your normal expectation when you invest into private credit, right? There's a reason that you get an excess spread. Part of it is because you're locking your money up in a less liquid investment, but part of it is you are investing into things that are inherently more risky. You are making loans to businesses that are inherently more risky. And some of the ways that you address those risks are through diversification, right? Making a lot of smaller loans. Some of the ways are by having, more protections for your credit, covenants in your loans. And one of the ways is just through enhanced due diligence if your sponsor has the ability to do that and they're very good at it.
Well, this sounds like there's a lot to do before year end. And when it comes to some of these investments, there's a lot to do just from a due diligence standpoint. I don't want to do all this myself. Where should I be going to take care of all this?
Well, that's a great point, Robert. So, I tend to think that at Avidian Wealth Solutions, we have a phenomenal due diligence investment team that looks at this stuff every day. We also partner with some of the top firms in the world to get the best private credit exposure that we can find. So if you want to take this a little bit deeper and just kind of have a conversation about this and how it might fit into your portfolio, just come check us out at avidianwealth.com.